Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if companies are cooking the books or just having a really good quarter. Today, we're diving into EQT Infrastructure Co LLC's latest report, and let's just say it is a bit sparse. Think of it as a company still getting its feet wet or maybe just testing the water temperature. This is their Form 10Q, a report filed quarterly by public companies. Think of it as a progress report for the last 3 months. But for EQT Infrastructure Co LLC, which is still in its early stages, this report is more about their setup than their performance. Let's head over to the financial tables. We're looking at the consolidated statements of assets and liabilities as of the 30th of September 2025. The company reports a total of $1,000 in cash and cash equivalents. That's not exactly a king's ransom, but it's what they had. They also have amounts due from their manager, EQT Partners Inc., totaling over $6.2 million. This means the manager owes them quite a bit of money. On the other side of the ledger, their total liabilities are quite significant at over $8.3 million. This means they owe a lot of money to various parties, including organization costs payable, legal and professional fees, and offering costs. Now, let's look at how much they've spent just to get started. Under organization costs for the 3 months ending the 30th of September 2025, they spent $233,400. For the 9 months ending the same date, that number jumps to $2,309,238. And for the period from their formation in June 2024 up until the 30th of September 2024, they spent a whopping $2,399,816 on organization. That's a lot of money just to get the company legally set up. Here is where it gets interesting. For all those expenses above, they have a line item, less expenses reimbursed by manager. And guess what? For the 3 months ending the 30th of September 2025, they were reimbursed the exact same amount they spent on expenses, $426,708. The same goes for the 9 months ending the 30th of September 2025, where they spent $3,535,768 and were reimbursed exactly that amount. This tells us that for now, their manager, EQT Partners Inc., is covering all their operational costs. This is part of an expense limitation agreement, meaning the manager promises that the company's specified expenses won't exceed a certain percentage of its net assets. So while the expenses are high, they are being covered. Let's dive a bit into the company's background. EQT Infrastructure Co LLC, or EQT as they call it, was formed in Delaware in June 2024. Their whole goal is to acquire, own, and manage other companies, essentially acting as a holding company. They want to do this through joint ventures, which are like partnerships with other investors. They operate in a way to avoid being classified as an investment company. It is all about acquiring and controlling portfolio companies globally, with a focus on infrastructure, but also looking at healthcare, technology, and business services. When it comes to valuing their investments, which they haven't really made yet, they follow a strict process. They use fair value, which is what they think they could sell an asset for in an orderly transaction. This involves looking at market prices if available, or using valuation models if not. They break this down into 3 levels. Level 1, which is unadjusted quoted prices from active markets. Level 2, which uses observable inputs for similar assets. And Level 3, which uses unobservable inputs, meaning there is a lot more guesswork involved. Since they haven't really bought anything yet, this is more about how they plan to value things down the road. This section is crucial because it details how the company interacts with its manager, EQT Partners Inc. They're going to enter into a management agreement where the manager helps them find and manage investments. There is also an expense limitation and reimbursement agreement. This agreement means the manager will cover certain expenses for the company, up to a limit until March 2026. If the company does well and makes money, it will have to reimburse the manager for these waived or reimbursed expenses. So, the manager is essentially fronting all the costs for now, but expects to be paid back later. When the company does start making money, the manager will be entitled to a management fee. It's expected to be 1.25% per year of the net asset value for certain classes of shares. This is a pretty standard fee in the investment world, but it means the manager gets paid regardless of how well the company performs. On top of the management fee, there is a performance allocation. This is a bigger chunk of the profits, 12.5%, that goes to EQT AB Group if the company performs well, meaning it exceeds a 5.0% annualized internal rate of return. This is also a common practice designed to incentivize the manager, but also means a significant portion of the profits will go to EQT AB Group. They even have a high watermark, which is a fancy way of saying that if the fund loses money 1 year, it has to make that money back and then some before the manager gets any performance bonus. Looking at the bottom line of the balance sheet, their net assets are listed as $1,000. This is made up of 40 Class Q shares and the net asset value per S-share is $25. This $1,000 represents the initial capital contribution made by EQT Holdings AB. So as of the 30th of September 2025, the company's entire net worth is just $1,000. They haven't bought any investments yet, which is why their financial statements are so thin. This section is where management explains what is going on. They reiterate that the company was formed in June 2024 and hasn't started commercial operations yet. Their focus has been on getting organized and registering with the SEC. They plan to acquire companies through joint ventures aiming for infrastructure, healthcare, and tech. They also plan to have a liquidity portfolio of about 20% of their assets, which includes things like cash and government securities, to provide income and liquidity, and to meet any share repurchase requests. Management also touches on the broader economic picture. They mention ongoing global market uncertainty, concerns about inflation, high interest rates, and geopolitical instability. They also point out potential shifts in US trade policy and new tariffs, and how these could affect businesses. It's typical for companies to mention these external factors, but for EQT Infrastructure Co LLC, it is more about setting the stage for the kind of risks they'll face once they actually start investing. This section is pretty straightforward. Since they haven't started their main business of acquiring companies, their results of operations are essentially null. They are still in the formation and registration phase. Their income is expected to come from the investments they eventually make, and their expenses are what we've already seen: organization costs, legal fees, and eventually management fees and performance allocations to their manager. As of the 30th of September 2025, the company had only $1,000 in cash. The EQT AB Group made that initial capital contribution. They expect to raise more money through their private offering and potentially future debt or equity offerings. They believe this will be enough to cover their needs for the next year and beyond. Their primary use of cash will be for acquiring portfolio companies, covering operational costs like management fees, debt service if they borrow money, and any share buybacks. This is where they detail how they'll value the companies they acquire. They mention that valuations can be tough, especially for companies without traded stocks. The manager has a lot of discretion here. They can use income approaches, market approaches, and other methods. They plan to use a valuation firm to ensure their valuations are reasonable. However, they admit that their valuations are estimates and may not reflect the actual realizable value. And here is the kicker: because the manager is responsible for these valuations, they have a potential conflict of interest, as it directly impacts the management fees and performance allocations they receive. This is something to keep a close eye on. So, what is the story here? EQT Infrastructure Co LLC is a company in its absolute infancy. They've spent a considerable amount of money on organization and initial setup, costs that their manager is currently covering. They have a clear strategy to invest in infrastructure and other sectors through joint ventures, and a robust fee structure for their manager that includes both a management fee and a performance allocation. However, at this stage, their financial statements are extremely light. Their total assets are minimal, and their liabilities are significant but appear to be covered by their manager for now. The company is essentially a shell waiting to be filled with investments and capital. Our take now. Let's decode this a bit. The biggest takeaway is that EQT Infrastructure Co LLC is in its very early stages. It's not generating revenue or profits because it hasn't made any significant investments yet. The large expenses are being borne by the manager, EQT Partners Inc., through a reimbursement agreement. This is a common strategy to get a fund off the ground without burdening the new entity with immediate costs. Strengths: the company benefits from the established EQT AB Group, which provides a strong platform for sourcing deals and offers expertise. The expense limitation agreement is a good sign for early investors, as it caps initial expenses covered by the company. The clear strategy and market focus on infrastructure are also positives. Weaknesses: the most significant weakness right now is the lack of operational history and invested capital. The company is entirely dependent on its manager and future capital raises. The potential conflict of interest regarding the valuation of portfolio companies, which directly impacts fees, is a notable risk. As they start acquiring assets, the complexity and risk will increase. Risks and opportunities: the primary risk is the successful deployment of capital into profitable investments and the ability to manage those investments effectively. The macroeconomic environment, as mentioned in the report, presents both challenges and opportunities. The company has the opportunity to tap into the global infrastructure market, which offers long-term growth potential. Conclusion: EQT Infrastructure Co LLC is a bit like a car parked in the garage, polished and ready to go. But with an empty gas tank and no driver yet, it has all the components and a capable manager, but its true performance is yet to be seen. Investors looking at this would be betting on the future potential and the EQT Group's track record rather than current financial performance. It's a long-term play, and the real story will unfold in future reports once they start making acquisitions. That is our breakdown of EQT Infrastructure Co LLC's latest filing. What is your take on a company starting with just $1,000 and a lot of management promise? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description to continue the conversation. Thanks for watching. See you next time.